Hi guys, in this video we are going to cover a very important topic associated with the SEBI Current Affairs for the upcoming SEBI Grade A 2018 examination, that is the recent mutual fund regulations which have been brought in by SEBI. So mutual funds, they are very important instruments associated with the securities market, and these are regulated by SEBI. And recently in the board meeting which has been concluded of SEBI, there are some changes which have been announced with regard to mutual funds. So in this video we are going to focus on those changes, and we have understood and analyzed that simply talking about those changes is not going to serve the purpose when you are not aware about the basic concepts of mutual funds. So at the same time we are going to cover all the basic concepts associated with the regulations which have been introduced, so that it enables you to gain a holistic understanding of the entire question and picture. So friends, we have been working in this direction of guiding students for competitive examinations for the past few years, and we have been blessed with some of the very amazing results. In RBI Grade B 2017, 27 of our students, they made it to the final list. And in NABARD Grade A 2018, 20 of our students, they were selected in the final list. And RBI Grade AB 2018, the final result is still awaited, but again we are positive on this front also. So friends, these are the courses which we are presently running for SEBI Grade A 2018. So you can choose as per your convenience, and we have made utmost effort to deliver you excellent content in all of these courses. And specifically for current affairs, we have tried to make sure that we do not cover just the news in question. We try to cover the basic concept related to the same, because it helps you to gain an holistic understanding about the entire concept in order to attempt your upcoming SEBI Grade A examination in a better way. So friends, these were the headlines which were in news recently, and they include: the SEBI recently clears a proposal to bring cost effectiveness in mutual funds. So SEBI is clearing the proposal, and SEBI is trying to bring cost effectiveness in mutual funds. So we have to understand what are these mutual funds, how these regulations they change the ambit of working of mutual funds, and all other related aspects we are going to discuss here. And there was another headline that SEBI makes investing in mutual funds cheaper, caps expense ratio at 1.05%. So this expense ratio is one of the very important terms which is associated with the mutual funds. So now if we are able to understand about this particular term, we'll be able to get a better hold on the regulation which has been brought recently with regard to mutual funds. So let's start with the introduction. Why there was a need for a review of total expense ratio, and why overall the mutual funds regulations they required a review. Now, if you look at the assets under management, now assets under management is a very important term which is associated with mutual fund. This includes the assets which a particular mutual fund company or an asset management company is managing. These assets, they have grown many-fold over the years. And as of 31st August 2018, so it's just a month just gone by, so the assets under management of the industry has crossed INR 25 lakh crore. So you can see how much this is a very big amount, and this is 25 lakh crore is the assets under management under mutual fund companies. So this indicates that the mutual funds, they have grown multiple times. They have grown multiple times since their inception. And now the economies of scale, the benefits which arise when there are economies of scale should be available to them, but they are not being shared with the investors. For those who are not aware about this concept, economies of scale, it means when you are producing on a very large basis. For example, if you are producing 10 cell phones, and if you are producing 100 cell phones, producing 100 cell phones is going to reduce your cost, because some of the costs are going to remain fixed, and the per unit cost for 100 cell phones is going to be less. So this is this concept of economies of scale. When you go long, your per unit cost is going to come down. So same goes for the case of mutual funds. So if you are having a huge amounts of assets under management, then your expense ratio should be getting lower, and these benefits they should be shared with investors. So this is the prime concern here. Further, the slab limits of total expense ratio, which were introduced in 1996. So the mutual fund regulations, they were introduced way back in 1996, and this total expense ratio, it was introduced then, and there was a slab which was kept for total expense ratio, and this has not been changed since then. So mutual fund expenses, they are still at the same percentage, but the assets, they have grown manifold. So the absolute amounts which the mutual funds are earning, it is very high. Now this TER stands for total expense ratio. We'll be using this term many a times in our discussion in this particular video, so it's better we understand the meaning of this one. This is going to be total expense ratio. So it is going to simply indicate the expenses which are there in managing of a mutual fund. We are going to discuss this in much detail in very technical terms in a later slide. Now, before we move forward and start analyzing the different aspects of these regulations, let us quickly look at the basic concepts which are covered in this regulation. So to understand this regulation in a holistic framework, it is required that we understand the basic concepts first. So first and foremost, we should be aware about this term, that is mutual funds. Now, I believe most of you would be aware about what are mutual funds, and just let us quickly revise these term, that is mutual funds. So this is a fund which is formed by collecting capital from different investors. So different investors, they are coming together and they are putting in money, and we are forming a fund. So this fund is going to be mutual fund. So it is shared by thousands of investors, and they come together so that when they are coming together, they are going to put in more money and they are going to earn more. So this is the logic behind it. And the person who is managing this investment vehicle, so there is a person who is here who is managing all the monies which are coming from different investors. This is known as professional fund manager. And these mutual funds, they are required to be registered with the SEBI, that is Securities and Exchange Board of India, and they are one of the most lucrative investment options. You can put your money, you can buy the units of the mutual funds, and you can earn a handsome amount of return. Now let's understand how the flow of funds happen in a mutual fund. So here is you are having some savings and you want to invest those savings in the mutual fund. So what do? You go to a mutual fund which is technically known as the asset management company. Now this asset management company has a person known as professional fund manager. So this is the person who is going to make all the important investment related decisions, and ultimately the money which you and all other persons they are bringing, they are going to be invested in different securities, bonds, or different kinds of instruments, so that they are able to generate excellent returns. So this money is going to be invested, and ultimately we are going to get returns which may be in the form of growth, or they may be in the form of dividend. So either the value of your units in the mutual fund, it is going to appreciate, or you are going to get the dividends from the mutual funds. So this is how the flow of funds occur in a mutual fund, and how the mutual funds facilitate the pooling of funds from thousands of investors to earn high rate of return. Now let us also quickly take a look at the features of mutual funds. So mutual funds, it is money pooled from various individuals or investors. So there are different investors who are coming together, they are pooling their money and they are creating this particular fund, and they are professionally managed. So we have seen that there is this person, that is professional manager, who is using his expertise to manage the fund. So this is the benefit of a mutual fund, that you can get the services of a professional. Now they are well regulated. We have seen that how these mutual funds, they have to be registered with SEBI, and there are regulations also of SEBI with regard to these. So they are well regulated by SEBI. So the chances of loss and any chances of misappropriation, they are very low, and they can generate higher returns than conventional investing. So if you are putting your money in a bank and you compare it with the investing in mutual funds, you may find that you will be able to generate higher returns in a mutual fund, though there are some risks attached, and these risks have to be taken if you wish to attain a higher rate of return. Also, you can access large portfolios. Now, individually, it may not have been possible for you to access such a large variety of shares in the market, but when there is a huge corpus which is there with the professionally managed mutual funds, they can access different kinds of securities, different kinds of funds. So this is why there is a large portfolio and there is diversification of risk. So this is another characteristic, that is diversification of risk. There is expert money management. This is because they are professionally managed, and they allow the individual, a single person can invest in a small amount. So this is the benefit for a small individual. Also, there is a concept of systematic investment planning, and you might have heard it as SIP. So systematic investment planning or SIP is also available, where you can just invest a small amount of money after a periodic intervals, and this will generate you handsome returns in the long run. So this facility is also available, and they are safe and secure because they are well regulated, professionally managed funds. Also, investments in the equity oriented mutual funds, we are going to understand what are these equity funds. Investments in equity oriented mutual funds is also eligible for tax benefits under the Income Tax Act. So if you invest in mutual funds, there is a series of benefits which are available to you. Now, when we take a look at the different types of mutual funds which are there, so broadly there are three types of funds. Now we'll discuss in detail, there are different types of funds, but broadly, this is the keyword here, broadly there are three types of funds. These are equity or growth funds, debt or bond or fixed income funds, or balanced or hybrid funds. Now, equity or growth funds mean when the mutual fund is going to invest money in the equity shares of the companies. So equity shares have this characteristic that they are useful for long run investors and they can generate a huge amount of money in the long run. So these are growth funds. But if you want a fixed return on your investment, then you should go for fixed income funds or debt or bond funds. So these mutual funds, they are investing in these kinds of securities. And when we talk about the balanced or hybrid funds, they are investing in a mix of equity and debt. So they invest in both equity and fixed income funds to balance the risks and maintain a certain rate of return. So they try to balance out the risk and give you the benefit of both the types of funds. So the equity funds, the keyword here is equities. The fund is going to invest in equities, and if the price of the shares rise, there is going to be profit, and this profit is going to be distributed with the mutual fund unit holders, and they are going to if they are going to get invested for a long time, they are going to get handsome returns, but they have to keep a higher risk appetite because they have to wait and earn. Now, if you learn about the debt or bond or fixed income funds, they are going to invest in fixed income securities like T-bills, bonds, or corporate deposits. They are relatively safer investments and are suitable for income generation. So these are for those investors who prefer more or less smooth kind of ride and they want a fixed return rather than fluctuating large amount of return. Now the mutual funds, they can also be classified as open-ended and close-ended mutual funds. Now, when we talk about the open-ended mutual funds, they are those funds which are always open. Their gates are always open. An investor can come, it can buy the units, and at any time it can sell those units back to the fund and exit. So these are open-ended funds. So they're buying and selling units on a continuous basis. Investors can enter and exit as per their convenience. So the number of units which have been issued by them, the outstanding units, they are going to be fluctuating. They are going to be up or down as and when the investor comes or it exits. So this is about open-ended funds. So this is giving you the flexibility to come and go at any point of time. Now there is another category which is close-ended funds. Now these are opposite of open-ended funds, and once the units are issued, they are going to remain fixed. You cannot sell those units back to the mutual fund before the completion of the tenure of those units. So if you want to get rid of those units which you have purchased, you have to get liquidity from an external source, that is stock exchange. So in these kinds of funds, the liquidity, it is provided through stock exchange, and if an investor wants to exit before the term, the fund houses list their close-ended schemes on a stock exchange, and those investors, they can sell their units on these exchanges and exit from the scheme. So this is about open-ended and close-ended mutual fund schemes. So now we have understood about the broad categories of mutual funds. Now there can also be another set of categories which will be relevant for our discussion on the SEBI regulations. So let us also quickly take a look at those sets of categories. So first one is interval scheme. Now this is very simple. We have learned about open-ended and close-ended mutual fund schemes. We have seen that open-ended, they are always open, close-ended, they are always closed. So this is a midway. This is a midway interval scheme. It is open for a predetermined intervals. That is why it is named as interval scheme. So they are combining the feature of open-ended and close-ended schemes, and they can be traded on the stock exchange, or they can also be open for sale to back to the mutual fund during predetermined intervals. Next is index schemes. Now index schemes are those which are tracking any particular index. For example, these can be tracking Sensex or Nifty. So the mutual fund which is running these kinds of index schemes, it is going to replicate the proportion of stocks as they are part of the Sensex or Nifty. So it is going to put its money in the different shares which form of the Sensex or Nifty, and as and when there is fluctuation in the shares, there will be fluctuation in the Sensex, and the fluctuation in Sensex is going to be reflected in the schemes of these mutual funds. So if you want to make your return going along with the market indices like Sensex or Nifty, you can make use of these kinds of index schemes. Then there are exchange traded funds, and these are those funds which are traded on a stock exchange. So they are traded on a stock exchange and they can track anything. They can be similar to the index schemes which track an index. They can track any commodity, bond, or a basket of assets like an index fund. So they can be tracking anything, but the most important thing is that these are going to be traded on a stock exchange. Next is fund of funds. So this is a very special kind of a mutual fund. This is that mutual fund which is investing in other mutual funds. So this is a very special set of mutual fund because it is not putting its money in the securities per se. It is investing its money in other mutual funds. So it is trying to get the benefits of the diversified portfolios of the different mutual funds by tracking those mutual funds. So this is the benefit of this. Now there is another very important term associated with the mutual fund, which is mutual fund commission. Now this is also going to be relevant for our discussion on the SEBI regulations. Now after we are done with all these terms, you are going to feel that the regulations, they are very easy. So that's why we are spending so much of time on these important terms. So first one here is upfront commission and next is trail commission. Now upfront means then and there only. So if you try to just literally understand this term, it is then and there. So it is just a one-time payment that a mutual fund pays a distributor on selling a mutual fund scheme to an investor. So what happens? There is a mutual fund and there is this person who is acting as a distributor of this mutual fund. This is like a person who has taken agency of the mutual fund, and here is you. So when this distributor convinces you, okay, you have to buy this fund, you are convinced, you actually acquire the units of the fund, the mutual fund is going to pay this person a commission. This is upfront commission. So this commission is to be paid when a new investor invests in a mutual fund. So your mutual fund agent will receive it whenever you invest newly. So whenever you are investing in a new set of scheme, this money is going to be earned by your agent. Next is trail commission. Now this trail commission means that this is going to be always there as soon as and when you are there, you are staying in this particular mutual fund scheme. So in trail commission, it is a recurring fee which is paid to the distributor. So you have invested in the mutual funds and you are remaining invested in the fund. You are not going anywhere. You are still associated with that particular fund, and the money which is paid to the distributor for keeping this investor associated with the fund is going to be a trail commission. So trail commission is a recurring fee paid to a distributor until the investment is withdrawn. So this will be paid to your agent even if you not invest, but if your investment stayed without withdrawal. So this is going to be paid to the distributor if as and when you are remaining committed to this mutual fund scheme and you are not going anywhere else. So this is trail commission. So these are the two important sets of commissions associated with mutual funds. Next is SEBI regulations vis-a-vis mutual funds. So we have learned about all these terms and they are all just covered under the SEBI regulations only. So it's just a slide that we have to make you aware that there are separate regulations for mutual funds which have been brought by SEBI, and they were brought back in 1996, and the aim was to protect the investors who are putting their money in the mutual fund. So they talk about the different aspects of mutual funds, like there has to be a sponsor, and this sponsor is going to be setting up the mutual funds as per the guidelines of Indian Trust Act 1882. And a trustee is going to be appointed through a trust deed which is going to be implemented by the sponsors of the fund, and the investment is to be managed by the asset management company as per the regulations of companies law. So these are the different components which are part of the structure of mutual fund. So let us quickly take a look at the structure of mutual fund. So let's take a look at the different sets of persons who are associated with the structure of mutual funds in India. So the most important person associated with the mutual funds, they are the sponsors of the fund. So they are the main persons who are establishing the mutual fund. So they are the persons who are going to appoint the trustees, and they're going to set up the asset management company. So what are trustees? Now trustees are appointed to secure the interest of the unit holders. The SEBI regulations, they mandate that you have to appoint these trustees so that the interest of unit holders can be protected, and in order to ensure that all the regulations of SEBI, they are being complied with. Then there is an asset management company. Asset management company manages the assets of the mutual fund. So we have understood how the mutual fund, it is going to acquire different kinds of assets and it is going to invest money in those assets. So to manage all those assets, there is this asset management company. Then there is a custodian. Custodian is responsible for safe custody of all the securities that are acquired by the asset management company. So this is just a safekeeper. And there is also this RTA, registrar and transfer agent. So this maintains and updates all the investor related records who are investing in this mutual funds. So this is about the different persons, different entities involved in a structure of mutual fund in India as per the SEBI regulations. So this is the example of a actual mutual fund structure. So here you can see this is an Axis mutual fund, and the mutual fund, it is sponsored by Axis Bank Limited. The trustee is Axis Mutual Fund Trustee Limited, and there are different sets of persons appointed. There is this asset manager also, and there are these auditors also, custodians also, registrar also. So there are different sets of persons associated with a mutual fund. Now let's talk about the expenses in management of a mutual fund. So we have understood the concept of mutual fund, how different investors, they are pooling a whole lot of money to come together to take benefit of diversification. So when a huge amount of money is to be managed and a professional person is to be appointed, there are definitely going to be some expenses. So they can be broadly divided into two categories: recurring expenses and non-recurring expenses. So recurring expenses, they are those expenses which are management fees, distributors commission, registrar fees, trustee fees, marketing expenses. So these are the expenses associated with the persons who are linked with the mutual fund, and also the marketing expenses, the regular expenses which have to be paid by the mutual funds. On the other side, there can be non-recurring expenses which are incurred just at the time of launch of a fund. So they are going to be one-time expense. When we have to launch a fund, we have to do different kinds of expenses to meet all the regulations which are there by the SEBI. In order to comply with all those regulations, you have to spend this money. So this is non-recurring. This is not going to occur in future. So this is usually borne by the fund house itself, and it is not charged to the investors. But this recurring expense is charged to the investors in the form of total expense ratio. So this is the concept, this is the base of this concept, total expense ratio, that there are some expenses of the mutual fund and they have to be charged to the investors. That is why this concept of total expense ratio, it came into picture. So this mutual fund companies, they have to charge some amount to the investors for managing their funds. So this is nothing. This is just the total expense ratio, that is TER. So you might be worrying about what is the meaning of this term. So now we have made it very clear and very simple what the meaning of this term is. Now why this term is an important term for investor? Because this is going to influence the return which this investor is going to get from the mutual fund. So for an investor, this is important because it is a charge levied on their investment. For example, if the firm produced a gross return of 15% and the total expense ratio is 2%, the investor is going to earn 13%. So those are fund made 15%, but since there is 2% total expense ratio, the fund is only going to give to the investor 13% as the net profit in its hands. So that is why this concept is important and relevant for investors. So this is how this total expense ratio is calculated. This is a very simple formula. Total expense ratio is equal to total fund costs divided by total fund assets. So if the assets of the fund, they are around 100 crores, and if the fund cost, this is around how much? This is around 2 crore. This would mean that this would become, total expense ratio would become 2%. So this is the concept of total expense ratio. Now let's come to what the regulations are about and how these regulations came into being. Now SEBI undertook an internal study to review the total expense ratio, and in this respect it constituted a mutual fund advisory committee. Now a working group was constituted by this committee to deliberate on the different aspects of mutual funds, and it brought different recommendations which were put before SEBI board, and SEBI board has recently approved various proposals pertaining to the same. So these are the broad categories of proposals which have been approved. The first one is transparency in expenses. So there has to be transparency in expenses which are being charged by the mutual funds to the scheme. Next is capping on the total expense ratio for different sets of schemes. So there should be some limit on this total expense ratio, and what is to be that limit that has been decided. Next is additional expenses in B30 cities. So this we are going to discuss. There is this another performance disclosure. So mutual funds, they should adequately disclose how much they are making money, how much they are earning through this term which is performance disclosure. Now if we talk about the transparency in expenses, this means all the commissions, all the expenses associated with the mutual fund. So all the expenses of the mutual fund, they shall necessarily be paid from the scheme only. So when you are going to pay the expenses from the scheme only, you are going to make sure that they are reflected to the investors in the accounts of this mutual fund. So this becomes very transparent. So that is why it has been announced that all the commission and expenses shall necessarily be paid from this scheme only and not from the AMC, associate, sponsor or trustee or any other route. So you are not going to take a benefit of any other route in order to make payments of expenses. You have to make all your expenses from this mutual fund only, because this is going to be something which is going to be in tab of under the radar of the regulators, and this is something which has been capped by the regulators also. So you cannot avoid this cap by changing the name of the expense or routing this expense through any other way. So this is the logic behind it. Further, the mutual fund industry must adopt the full trail model of commission in all expenses without paying any upfront commission or upfronting of any trail commission. So this is very simple. We have understood that there are two sets of commission. One is upfront commission and the another one is trail commission. So it is saying that the mutual funds, they should pay trail commission. Trail commission is something which is paid when the investor remains invested with the mutual fund. So if this kind of commission is being paid, this would ensure that the mutual fund distributors, they do not just convince investors to keep switching between the different sets of schemes in order to get these upfront commissions, and this would prevent mis-selling of the mutual fund assets. So this is the rationale, this is the logic behind it, that SEBI is pulling towards a trail model of commission rather than upfront commission. Next is a carve-out has also been provided for upfronting of trail commission in the case of SIP subject to certain conditions. Now this is not very relevant. This simply says that there is an exception to this second statement, that though this trail model of commission has to be adopted, but in some cases you can pay upfront commission also. So this is for SIPs, this facility is going to be available subject to certain conditions. Now let's take a look at what is going to be the total expense ratio for open-ended schemes as per the new SEBI regulations. So what is going to be the total expense ratio? So this total expense ratio is going to be dependent on different factors. So first, it is going to be dependent on whether this is an equity oriented scheme or whether this is any other scheme. So in case of an equity oriented scheme, there is a risk in the market because these fluctuate often and often. So that's why the professional fund manager often has to make churning in the fund. He has to take important decisions time and again. So naturally his expenses are going to be higher. So that's why you can see a higher ratio is here as compared to other schemes. So this would depend on the assets under management. So if you are having higher assets under management, remember the concept of economies of scale, you would get those benefits, and that's why your total expense ratio is going to be lower. If your assets under management are low, then you can charge a higher total expense ratio. So if your assets under management are up to 500 crores, this would be 2.25% for equity oriented schemes and 2% for other schemes. So this goes on like this. As your assets are increasing, your total expense ratio is decreasing. So this is the benefits of economies of scale. So as and when your assets, they exceed 50,000 crores, your total expense ratio is going to be capped at 1.05% for equity oriented open-ended schemes and 0.8% for other schemes. So here this open-ended is also relevant because when you talk about the open-ended schemes, they are always open and they have to bear some expenses because the investors are coming in, they are going out, there is processing charges and other charges associated. So that's why you'll see that for open-ended schemes, a higher total expense ratio is available. So if we compare this with closed-ended and interval schemes, you will see that the total expense ratio for these kinds of scheme, it is capped at 1.25%. And for other than equity oriented schemes, this is capped at maximum of 1%. So closed-ended and interval equity schemes 1.25%, other schemes 1%. So this is how the situation is working. So on the top is open-ended and on the top is equity. On the bottom, we talk about close-ended and we talk about other sets of mutual fund schemes. So this we have to remember, capping is to be higher for equity and open-ended and lower for these close-ended and other than equity. Now for index funds and exchange traded funds, these are terms which we have already discussed. So now you understand why we discuss these terms in advance. So because now we are very clear about these terms. So for these, the total expense ratio has to be capped at a maximum of 1%. And for fund of funds also, this total expense ratio shall be maximum of twice the TER of the underlying funds. So these funds, they are going to invest their money in the mutual fund. So their TER is going to be dependent on the TER of this mutual fund. So this is how the thing is going to work for fund of funds. Now let's come to the next term, which is additional expenses. So additional expenses, they are permitted for charging by the mutual funds in case they are penetrating the mutual fund schemes in the smaller cities, and the term which is used here is B30 cities. So when we talk about the penetration of mutual funds, this SEBI has made this classification that there are some top 30 cities and there are some bottom 30 cities or beyond the top 30 cities. So in the top 30 cities, the mutual fund penetration is already high. So we want the mutual fund houses should visit these cities which are beyond the top 30 cities, that is the smaller cities. So to promote the mutual funds, to incentivize the mutual funds, we are allowing them to charge an additional expense for going in these cities. But the SEBI has said that these additional expenses is going to be allowed only if there is inflow from retail investor. If the institutional investors are coming from beyond the top 30 cities, this is not going to be available, because we want to increase the penetration among retail investors, and we do not want the institutional investors should misuse this additional expense facility by undertaking any kind of arrangement with the mutual fund house. So that has been ensured now, and the definition of retail investor is still under doubt, and this is going to be clarified later on. And for the time being, SEBI has said that the additional incentive shall be permitted for inflows from individual investors only. So we have made these two terms synonymous here, retail investors and individual investors, and not on the basis of inflows from companies and institutions. Further, the B30 incentive shall be paid as trail only, so it cannot be paid upfront. It will be paid as trail only. So this is important here. Now there is this another term related to this regulations, which is performance disclosure. So SEBI has also said that there should be adequate disclosure of all the returns which the mutual fund schemes they are making, and this has to be category wise, and it should be displayed on the website of AMFI. Now this is a very important institution which is associated with the mutual fund, and this one stands for Association of Mutual Funds in India. So this is the AMFI, this is the Association of SEBI Registered Mutual Funds, which was incorporated in 1995 as a non-profit organization to develop the Indian mutual fund industry. So this one was incorporated to develop the Indian mutual fund industry and to protect and promote the interest of mutual funds and their unit holders. So this association is very important in the context of mutual funds, and it has been entrusted with the responsibility of keeping a check on the mutual funds. Now, how these changes they are going to affect the mutual fund houses? Now, for the mutual funds companies, this can lead to a loss of revenue, because now their expenses they are going to be charged at a lower rate. But the magnitude of the impact, it will become clear only after a certain point of time, when we understand how the mutual funds are dealing with these kind of new regulations. But one thing that is clear is that SEBI has again upholded the interest of the investors in mutual funds, and this is very important. So now let's take a look at some of the MCQs which can be framed out of this discussion. Which of the following are the benefits of investing in mutual funds? So this one will be very easy for the guys who have understood the concept of mutual funds. Professional management, well-regulated tax concessions, or all of the above. So this we have seen that all of the benefits they are available with the mutual funds. So answer is going to be option number D. Next is, which is incorrect regarding fixed income funds? They invest in securities like treasury bills and bonds or reputed corporate deposits. They are suited for investors who have higher risk appetite. So this we have seen that fixed income funds, they are mainly for investors who have lower risk appetite and not for higher risk appetite, because if you are having a higher risk appetite, you will be going for equity schemes. So here option number second is going to be wrong. So the answer is going to be option number B. Next, dash schemes combine the feature of open-ended and close-ended mutual fund schemes. So here the options are index, fund of funds, interval, or hybrid. So this we have covered that the interval schemes they combine the feature of open-ended and close-ended mutual fund schemes. So the answer here is going to be option number C. Next is, which of the following is primarily responsible for securing the interest of unit holders while making sure that the mutual fund complies with all the regulations of SEBI? Options are sponsor, trustee, custodian, or asset management company. So this also we have discussed that trustee is entrusted with the responsibility of securing the interest of unit holder and compliance with the SEBI regulations. Next is, as per the recent SEBI regulations, the total expense ratio of equity oriented open fund schemes with assets under management exceeding 50,000 crores has been capped at. So this we have seen that for these mutual funds, the ratio has been capped at 1.05%. So answer is going to be option number C here. Next is, as per the recent SEBI regulations, additional expenses permitted for mutual fund penetration in B30 cities shall be based on inflows from which of the following? So again, we have seen that the expenses, they are going to be allowed only for inflows from retail investors and not institutional investors. So the answer is going to be option number A here. So friends, these are the answers. So friends, this was all about our discussion on a very important topic pertaining to the current affairs relating to the mutual fund industry in India. So friends, this was all about our discussion on some of the very important MCQs pertaining to the securities market. And if you have any query or you wish to know more about our courses, you can visit our website, which is www.edutap.co.in, or you can drop us a mail at hello@edutap.co.in, or you can call us at 8146207241. So friends, if you found this video useful, please like the same, share it with your friends, and subscribe to our YouTube channel. And if you wish to get regular updates on Telegram, you can subscribe to our Telegram channel, the link of which is given here as well as in the description to this particular video. And subscribing to our Telegram channel is also going to help you fetch the PDFs of all the discussions which we are doing on YouTube. So thank you friends.